Kia ora, everyone. Welcome along to our My Mortgage webinar tonight from Homeowner to Investor, where we're going to be sharing some top tips for your first investment property. Now, this is something that we're getting asked a lot at the moment. And a lot of it is around, hey, how can I move things forward? What are the specifics around borrowing, around serviceability? What do LVRs and equity mean? So we're going to start by introducing ourselves a wee bit, and then we will crack right into it. So tonight we'll probably have you for maybe about 45 minutes, depending on how many questions we have. We'll run through our slides, a few examples, and then, yeah, please do reach out in the chat. We have the lovely Amy supporting us tonight, managing the questions, and so please do fire away if there's anything that you'd like to know at any stage, and we'll try and pick those up as we go. So first of all, for those of you who don't know me, I'm Claire Williamson. I'm one of the directors and mortgage advisors here at My Mortgage. And tonight I'm lucky enough to have Mr. Greg Wallace with me as well. A little bit about us at My Mortgage. So we aim to kind of be a little bit more fun and less boring. It seems to be a little bit of a bank thing to maybe be perceived as a little bit more boring in the financial services industry. So we try and make that a little bit more fun. We've been around for a wee while, about 15 years at My Mortgage. I've been around for nearly 10. Greg, I'm not sure how long you've been with us, but it's very exciting.
Maybe 6 years now.
Six, seven maybe. Yeah, and we also have a pretty young team as well. So we like to, you'll notice we keep things pretty technology driven. We try to be as dynamic as possible. And this is just, a good example of us being a bit silly and having fun. So Greg is going to take the starting point and introduce what we're going to be talking about tonight.
Yeah, thanks, Claire. Evening, everybody. So, yeah, we're going to go through a few things. Lots of questions we get asked about what is next in people's property journey. They've brought their first home, maybe they've brought their second home. They got a bit of equity there. People trying to figure out what is actually equity, what have I got that's usable equity, things like that. So we'll talk through that. How to work out what you can actually afford, both from an equity point of view and then servicing as well. What it might look like to buy your first investment property, what types of properties you could consider, and the kind of pros and cons. Maybe some mistakes to avoid as well, and we see a few of them. And as Claire mentioned, please ask any questions kind of as we go. If it works for us to answer them right then and there, we will. Otherwise, we'll jump on them at the end as well. Cool. So first up, Claire's going to take us through calculating equity and what does it actually mean?
So I feel like equity is one of those things that people just like throw around this term of like, oh, well, if you've got heaps of equity, then that's going to be all good. But what does that actually mean? Well, it's the difference between what you've borrowed and what the value of your property is. So let's say your property is worth $1 million and you owe 500,000. The difference between 1 million and 500,000 is your equity. But the equity is different to the usable equity. So what we call usable equity is the amount of equity that you have, which can effectively be used as a deposit for an investment property or for anything else. You can top up for other things like renovations and cars and things like that as well. But in this context, we're looking at usable equity from the perspective of it becoming a deposit for an investment property. So where that kind of leads us to is not needing to have a deposit to purchase another property. And a lot of people call that leverage. So looking to leverage my property to purchase the second one is essentially what we're talking about today. So talking about how equity comes about and then how to work out what your usable equity is and the fact that yeah, you don't need to have a cash deposit, 100 grand, one of those hard things that's quite hard to save that much money to buy your second property. And this is something that a lot of people come to us with questions on because they want to understand, well, hey, if I did want to buy something else, what would my position look like and how could I get there? So not requiring a deposit is generally leveraging your property and utilising that usable equity. So on the next slide, we've got a bit of an example that Greg's just going to talk through. Actually
Yeah,
similar to the one I've seen.
so yeah, as
Yep.
Claire mentioned, so if your property is worth $1 million, the borrowing available is up to 80%. So you can borrow 80% of the value of your own home in any situation. So as Claire mentioned, It could be to buy your house, but it also could be to top up to do renovations or things like that. And as Claire mentioned, for our situations tonight, we're talking about using it to buy an investment property. So say if your current lending was 600,000, you have 200,000 of usable equity because the bank won't let us borrow any more than 800 against that property. So we've got 200,000 we can use as usable equity. And right now, the Reserve Bank have limits on how much you can borrow against an investment property. So the loan to value ratio for an investment property is 70%. So that means we can use our usable equity as a 30% deposit to buy an investment property. And so then we've got $200,000 of usable equity. If we use that as that 30% deposit, then we could purchase a property for 666K. So pretty much that usable equity becomes that 30% deposit. But as Claire mentioned, we can actually borrow the full amount, the 100% of the purchase price of an investment property using that equity. And we'll talk a little bit later about whether we do that with the same bank. So we borrow it all with one bank, or whether we actually take that 200,000 of usable equity in this situation and take it to a different bank and purchase there.
Cool. So, alongside equity is also the value of your existing property and affordability. So, affordability just means how much can you borrow when you're considering your income, less the existing expenses and financial commitments that you have. So, that might be your existing loan amount that you're paying to the bank for your existing loan, your repayment every week, fortnight, or month, but also things like your rates and insurance and all of that stuff as well. And the bank will factor that into the new scenario for the new investment property as well. So in this situation, they'll use both your personal income, so that might be a salary or wage job. You could be also in business, so that could be another place that you might have income, and then rental income, whether it's existing or projected rental income for the new property. But you do still have to service the equity that you're using. So if we just refer back to that example before where Greg was talking about the 200,000 and then being able to buy for 666, we promise we don't in the deal with the devil. That whole amount then needs to be serviced. So you're not only borrowing the amount for the property, you're also borrowing the deposit. So that full amount needs to be serviced. So we're just mentioning there you still need to be able to afford to service the equity part. So it's not just the 70% for the new property. Another thing we thought just worth explaining there is how to establish your property value. So what we call an IVAL or a desktop valuation. Some banks call it other things. Sometimes that's in line with what you see on some of those sites like homes.co.nz or TradeMe, realestate.co.nz. And IVAL is kind of a broad, what they call a desktop valuation or an initial valuation. A registered valuation is where a registered valuer goes into a property and basically says, hey, compared to others that have sold recently, this is the value. So that's kind of considered the gold standard, but it is relatively costly to get one of those. So you need to consider how much you want to spend and how much you think your property's worth. So those are two ways to establish value. And the third one is sometimes the GV or the CV, the government valuation or the capital valuation. So those are probably less relied upon in recent times because we've had some changes in the property market. So we always start when we're looking at equity, we look at the IVAL or the desktop valuation. And if that seems a bit low, or we think that the property might have had some improvements, or you might have done a big extension or some renovations, then we might consider something like a registered valuation to kind of consider that affordability and value. Sorry.
Also, you'll find with those IVALs, the banks will often be putting them into your online banking now as well. So if you log in
Yes.
as, say, an ANZ customer in there, they'll have a valuation. It'll say it's come from a place called CoreLogic, which is just one of the companies that values it. And so you'll be able to see that in there, and that'll give you an idea of the value the bank holds for that property. So if the numbers work out with that, then great, we don't need to pay for a valuation. But if we do think it is higher and they've got it undervalued, then it can be worth doing doing that. Cool. We're just going to run through two quick case studies. So first one here, we've got Jordan and Ashley. So they've owned a property for 5 years. It's now worth 900K and they've got existing lending of 495,000. So using those numbers we were talking about before, that we can borrow up to 80% of the value of their own home. We've got about 225,000 of usable equity. Cool. So that usable equity, if we use that as a 30% deposit, that can get us to a purchase price for the new property of 750K. Incomes there, we've got two incomes of 105 and 75,000. So good incomes, weekly rental income of 650. Often we get people saying, hey, look, the rental income, I've run the numbers on 5% interest, and the rental income is going to cover everything to do with the cost of the house, which is awesome in terms of the mortgage. The issue with that is, though, the banks scale things. They'll add rates and insurance to that. They'll scale it by 80% to make sure that you're covered for times where maybe the property isn't rented out, things like that. Repairs and maintenance. So even though it might cover it practically, we still need to have other income to be able to kind of top that up from the bank's point of view as well. And a new thing there we just add at the bottom, this came in about 18 months ago, is DTI. So that's debt to income ratio. And so that is the ratio of your total debt that you have and the amount of income you have. So that's your income from your salary or your business or however you get your main income plus your rental income. And it needs to be under 7 for a investment property. So that's 7 times your income needs to be at least the same or lower than your total debt that you have. So say if you earn 200 grand, then 7 times that is 1.4 million. So you could have 1.4 million of debt from a DTI point of view. At the moment, we're just starting to see people touch that because the banks have lots of other things as well that limit how much you can borrow in terms of servicing and things like that. So there's a example there with Jordan and Ashley where they're buying a existing property.
Cool. Awesome. Yeah. So that's a really common example. So we've tried to make that as close to one of our current clients that we're doing work for. And that's a very common situation. This is another one that we see a lot. So Matt and Emily, who have owned their property for 3 years, worth about 850. Currently, they've got 550,000 owing. So their equity is 300,000, but their usable equity is 130K. Their incomes are 90 and 60, so good joint income there. Their usable equity means that they could buy a property at a purchase price of 430K, and that's using the 130 as a 30% deposit. But they might be able to look at a build as another option. So this is actually one that I've had recently where the usable equity was a little bit lower, so that allowed for a 650K build at 20% equity. So the exemption for the LVR or the 30% deposit rules that we talked about earlier is for a new build. Those are becoming popular as first investment properties because they are a little bit easier to access funding for. And what's really common is that you have a really good strong income, but you might be still building up your equity over time. So this is just an example of how to get into an investment property, but you also do have to look at things like cash flow, like cost. In this situation, for example, the rental income is quite strong. So for a 650K build at $700 a week, that's a pretty good rental income. But it's also got to tick a whole lot of other boxes as well. But definitely something investors are looking at a bit more, a bit more. New builds, they're great with things like not having maintenance, and actually just being able to sort of roll on and pop your tenants in there, have a good steady stream of income, but not need to be, fixing things and things like water heaters and carpet and stuff like that. So it's definitely a consideration, and we wanted to pop that in there so that you can see what the differences look like when you look at that purchase price, say at 430 compared to say 650. And these are just obviously numbers that do fit here in the Waikato. So depending on where you are, we can apply it to you in your situation. Oh, okay.
Yeah, and especially in the last little while, we have seen property prices or values come back a little bit. So some people don't have quite as much equity as they had, say, maybe 3 or 4 years ago, and so then those using that usable equity to be able to buy an existing property versus a new build, the new build can be quite useful. So in terms of types of investment properties, um, we're not going to we're not going to tell you whether it's a good property or bad property. That's not exclusively our job, but we can run the numbers for you. But a few things to consider. So one thing is whether you're looking at capital growth versus cash flow. So by that, what we mean, capital growth, generally properties that are on their own title. So they're kind of standalone, or maybe they are in slightly more expensive areas. They'll have better capital growth, or they're in a location that still has a little bit of growth to be had, versus maybe an apartment, which maybe doesn't have the same capital growth but has better cash flow. And so, depending on your strategy, and some of our clients, they'll have some of their properties in their portfolio that might be for capital growth and others that might be for cash flow. Some are going purely cash flow and they'll only buy properties that have multiple dwellings on there so they can rent them both out, or they'll be right into the apartment market because they can get really good returns. So it's really important to understand the type of property you're looking at, whether you're looking at one that's going to have really good capital growth or really good cash flow. Now, you could also have one that sits nicely in the middle and does a bit of both as well. So it's not kind of an either or thing, it could be a combination. Obviously, considering the location is really important. Is it the place that you're going to get good tenants? Is it the type of place that's growing and people actually want to move there, and are going to need rental properties? Things like schools are really important. Universities, lots of investors do a lot around university towns as well, because there's always tenants to be had there. Just be aware of hidden costs. Obviously, you've got your rental manager. If you're not going to do it yourself, if you're not going to manage the property yourself, you need a property manager. Property managers, a good one, is worth their weight in gold in terms of making sure your house is looked after, but also that you've got the right tenants. And if you needed to exit tenants, that they're going to do that for you. So we would always recommend having a property manager. Other things like body corp fees. So like I was talking before, a freehold house, so a house on its own section, is not probably going to have any body corp fees, whereas an apartment or a unit, there's probably going to be some body corp fees, and that can often eat into your returns as well. So just something to be aware of when you're looking at it. Might look like a great return with the cost of the property and the rent you're going to get from it. But then once you add in body corp fees, it could be 3, 4, 5 grand a year, which is going to eat into that. How do you know what's best for you? Well, that's it depends on your personal situation. That's where getting really good advice. We'll talk a little bit about having a good group of people around you, and so having conversations with people. Listen to some people. Don't listen to everybody. Just because something is good for one person doesn't mean it's going to be right for someone else. So it sometimes can take a little bit of time to find the right type of property and the things that you're looking for, and then you kind of get to know the places to look, the types of properties, and what's going to work. One thing to note is around Airbnb. We get asked this a lot as well. Lots of people starting to look towards beach towns and holiday destinations to buy properties. You can absolutely Airbnb a property. That's fine. The banks won't take Airbnb income as a type of income until it's been there for probably 2 years. And it would need a set of financials behind it and all those sorts of things as well. So the bank won't rely on that Airbnb income, but but it can be used down the track. But in the short term, even if you are going to Airbnb it, we can get a rental appraisal done that'll show it's going to rent for 700 a week. Happy days. If you then choose to Airbnb it and you're making 1,200, 1,500 a week, that's amazing.
Yeah. Yay, lucky you, you made a great call. We do actually just have a quick question here, which I'll just read out. So, just going back to the LVR exemption for new builds, would that be a land and home package instance? If not, then you'd need to buy the land first. Yeah, so this is a really good question. Traditionally, we would look at it as a house and land package. So it depends a little bit on the situation because what's happening a lot now is the cost of land is getting a little bit more expensive. A lot of builders will be selling new build properties at packaged cost. So it might be 850K and 350 of that might be the land, or 400 of that might be the land, and the remainder might be the build. Generally, if there is a package deal as a whole, so you've actually got that overall price. A bank will look at it under that exemption as long as that's a package price that's going to be kind of maintained. So essentially, you do maybe buy the land first, but the price for the house is locked in and it's an overall package. So you might settle the land first, but then you pay progress payments for the build like you normally would. So the builds that I was talking about in the earlier LVR exemptions were probably more leaning towards things like townhouses, which do tend to be built and then sold as a, hey, it's this price. But then there's also some that you can buy off the plans as well, which is, hey, it's going to be built in a year, 18 months, 2 years, and then you purchase it with a 10% deposit and a commitment to settle in the 2 year period. So there's quite a few different things that go on with builds. So it'd probably be case by case. And if you did have one, I think that was Stephanie that asked that question. If you did have one, Stephanie, just reach out to us and we're happy to give you some specific advice. Yeah. So, something that comes up a lot is using more than one lender, or what some people refer to as the split bank approach. So, there's actually a whole lot of really cool pros to this as well, but there are also some cons. So, wanted to talk through some of the reasons why you might do this, but also at the end there, I'll cover a couple of the reasons that you may not. So, the first one is flexibility. So, essentially, if you have lending at two different banks and you sell one of those properties, the bank with the lending where you've sold, you only need to repay that lending. They don't have any control over the other properties that you own or the other lending that you have with a different bank. So that just gives you flexibility, because if you've purchased a property and you're selling it in 5 years' time, might be making a nice profit, and you might want to have the flexibility to do something with that money, and you might want to put it into a business or into renovations or into something else. So it's up to you then to make that call. Sometimes splitting banks can give you a bit more borrowing power. So specific banks can be a little bit better with different types of income. So things like business, bonus, commissions, and even some different types of rental incomes in situations with household dwellings, or the like. So sometimes borrowing power can be better. Another situation where it can be better is if you might have been a client of a particular bank for 5 years, 6 years, 7 years, but another bank will treat you as a new customer. So they'd look at your loan term over a longer loan term, which could improve your borrowing capacity. So it depends a little bit on the situation, on your income, your equity, etc. But sometimes there's a bit more borrowing power there. Some lenders treat income expenses differently. So things like rates and insurance, which Greg talked about before. Some lenders have a bit of a kind of standard amount that they charge there, but others will have sort of more actual figures. So it depends a little bit on the lender as to how that's treated. There's also other product differences as well. So some banks have things called offsets or revolving credit options. So products where if you have a large amount of money, you can allocate it to a floating loan and hopefully, well, reduce your interest cost. That might be you, it might be someone that you know, or it might be a situation that's changed over time. There was also for a little while some particular build products that were cheaper and therefore kind of a better option for a lot of people. So if those products change again over time, then it will make a difference to policy. Asset protection is another big one. I've had several clients recently approach me to separate their business interests from their residential property investments. And the reason for that is just to de-risk slightly. If you've got a business that carries quite a bit of debt or has a certain level of risk for whatever reason, having that bank kind of control your investment properties as well, and then having something go wrong with your business can be pretty risky. And I've unfortunately seen this happen a couple of times, so that's definitely something important. And another one we see a lot is agri lending, so situations where farmers might have purchased an investment property and they've sold it, and then the bank says, "Oh, hey, you need to pay down some of your farm lending, please." So it's all about getting that balance right. The last note there is if we were looking back to those situations that we had earlier when we were looking at that usable equity and essentially borrowing the deposit, what we're referring to here is that it is possible to borrow that deposit separately at your existing bank and then go to a new bank or a second lender for the other 70% of that property purchase value. So it just splits the your owner occupied property with your investment property, which can be quite nice, but also it gives you a lot of that flexibility. What it does mean, though, is that you wind up with different loans at different banks. Some people just don't like that. And actually, I've more than once had this conversation where a client has said, "Oh, I feel really bad. I just want to stay with this bank." And I'm like, "No, no, that's fine. It's up to us to provide the option." And some people just prefer to stay with one bank, and that's absolutely fine. There are pros, which is just that it's a bit simpler. But then, as long as you understand the implications of the cons, then it's absolutely fine. It is a really cool way just to spread your risk around, to access a bunch of different policies, sometimes to get better borrowing power and things like that. But it's not for everyone, so it's just a bit of an idea. There's actually another question here. Um, are there situations where you can't have more than one lender in order to use your usable equity? Um, yeah, that's a really good question. So generally what will happen is if you are buying an investment property and there's a portion that you're borrowing for the deposit piece, and then you're approaching a new lender for the second part or the main part of the lending, both banks will want to see what you're spending the money on. So the first one will say, "Cool, if you want $200,000 as a deposit for this new property, that's okay as long as we know that the overall scenario with you having this new lending in place is still going to be affordable for you, and that we're going to be comfortable with that level of risk." So I've never had a bank turn it down, I don't think. Have you, Greg?
No, I don't think so.
No.
Yeah, yeah, the only other thing would be, yeah, like you're mentioning, the overall servicing. One bank, your home
Mm,
bank might do it all, and the other bank
mm,
might not. Stuff like that.
mm.
Yeah.
Yeah, yeah. So yeah, really good question.
Oh, actually, the only
Um,
other thing could be, sorry, just thinking that through, if one bank wouldn't take the new property as security for some
oh
reason, but
yes,
another
there's
bank,
something wrong with it.
the
Or
original bank
yeah.
might, or something like that. We've had that a few times where there was something to do with the title, and one bank had an issue with it, and another bank didn't. And so we logically did that, stayed with the main bank, or refinanced everything across to the new bank. So there are a few pretty, I'd say, edge cases where
Mm,
you couldn't split banking, but most of the time it's not a problem.
yeah. Yeah, and it also depends a little bit on your plan long term as well. So
Mm.
lots of the time, if people have ended up with a lot of equity over, say, a period of 5 or 10 years, they might actually want to get into a situation where all of their lending is only held by investment properties. And so if that's your goal, um, then we recommend a slightly different structure for you compared to if you just want to leverage your property to purchase investment properties, in perpetuity or however long that's a possibility for you. So it's just about going, cool, what's really important, and then yeah, how does that fit in with what the lending policies, etc., dictate?
Yeah, totally. So, a few common mistakes that we see that you need to try and avoid, and some things are unavoidable. Things like government policy changes. We've seen that recently with
Mm,
the Bright Line test. So, Bright Line is how long after selling a property, an investment property, you don't have to pay tax on it. And it started at 2 years, and then went to 5 years, and then went to 10 years. And so all of a sudden, it was kind of a bit of a moving target for people. Same things with the previous government had some interest deductibility changes, and so all of a sudden that was changing for people as well. So sometimes you can't avoid those things, and they're just part and parcel of being an investor. But in terms of things you can avoid, so first thing, rush in with no plan or strategy. We often see this where people become landlords by mistake. So maybe they go and they've got their original home, and then they just want to buy another one for themselves, and so their first home becomes an investment property. but they haven't ever actually thought through, is this actually a good property to be an investment property? Is it in the right location? Is it going to be low maintenance? All those sorts of things. So without having a plan or a strategy, sometimes you can end up buying the wrong property. Listening to the wrong people. We talked about that a little bit earlier. I remember I've spoken to Claire about this a lot because it sits poorly with me. I went to a I went to a seminar once and listened to a big time investor. He had lots of properties, was worth millions of dollars, and he was just giving terrible advice about, oh, well, I only buy properties that have 10 bedrooms that are unconsented, and I only pay cash for them. And it's like, cool, that's great for him and his situation, but that doesn't work for normal people. That's not a possibility. And so yeah, making sure you're listening to the right people who are giving good advice. And they can be friends and family, but sometimes family don't give the greatest advice. But I would just be really cautious of what we're terming finfluencers. So,
Mm.
people, TikTok, Instagram, giving real generic advice. So make sure you're getting good advice from good people. Misjudging the costs. So, can be really easy to go and go, oh, great, look, right now, interest rates are at about 5%. The numbers all stack up. Let's go and buy properties. And then, oh, hang on a second, the roof needs to be fixed. Interest rates have gone up, and I can't get good tenants. And next minute, the numbers don't quite stack up. So it's just making sure, being really realistic about what those numbers might look like and the costs associated with it. Lack of research that kind of talks around the plan and strategy, location or property type. Buying the wrong property type, we talked before about capital gains versus cash flow. You might buy a property that has great cash flow and then realize in 3 years you need to sell and you haven't made any capital gains. If that was your going to be a plan or your strategy, then that's something to think about at the start. And also making sure you get the right tax and legal structures set up early. So we're not going to go into too much detail about those, but it could be in a family trust, it could be in a look-through company, it could be in your personal names. That might actually be the best thing for you. But getting good tax advice from an accountant and getting good legal advice from a solicitor is really important. And if you've got a plan to do, um, maybe you've only got a plan to do one investment property, then that will have quite a different tax and legal structure potentially than if you're looking to do 10 or 15 or 20. So really important to have those conversations early.
Mm. I'd just like to add, just before we run on to taking the next steps, that I'm having a lot of conversations with people about what types of investment property purchases fit for their situation and the time that they've got, the income that they've got, the surplus income or the savings or the equity that they have, and how that fits in with their long-term plan. So, to give you an example, I had a family with a business, really good income, so surplus income, very strong position. Her family lived down in Hamner Springs. And while I wouldn't normally say Hamner Springs is a great place to invest for any particular reason, it actually worked really well for her. Her dad was a handyman, and so for them to purchase there in a town where there was some good holiday fundamentals plus good support made heaps of sense. But for me to buy there would have been a really bad idea because I don't have any connections. I don't know what the market's like. And so I think just that example, I think is really, it's really important to get the right fit for your situation and for the amount of work, time, and money that you want to put in to whatever this next purchase looks like. So another example is I often talk about doctors, right? They often earn really well, which is fabulous, but they're also quite time poor. So to give a doctor a renovation is probably not the greatest of ideas unless they want it to take a wee while or they're particularly handy. But that is often a good situation to go, hey, we want low maintenance, we want something that's just going to bring in some funds every week, but potentially have a little bit of extra income to top it up if need be. So there's just a lot of, I suppose, different things to consider. So just look at those different thoughts when you're looking at the investment that might suit you. Um, taking the next steps. So, actually, probably I've covered this. So, what does success look like to you? So, are you actually looking to generate extra income? So, cash flow. Might you be looking at things like multi-household application properties? Sorry, or would you like to add an extra room? Do you have the capacity to do that? Or are you looking at something that's a little bit more lock and leave, some sort of long-term plan. Maybe there's a good sized piece of land, or you might have the capacity to build something on the back of a property over time. Or is it a stepping stone to something else? Is it an investment property that might eventually be sold and purchasing another family home? Um, Depending on what that looks like to you will depend on what's the right option. And again, just speaking to what Greg said before and taking that advice from good people who have done what you're looking to do. Know your numbers and what you can borrow. While this one might sound a little bit obvious, it is definitely really important to go, hey, if your property was worth 850, you could do X. If you had this much more income or this much more rental, you could do X. So I've got a situation at the moment with a first home buyer and her partner, who is a second home buyer, and they're actually looking for something where they can generate a little bit of income on the side. So they're effectively going to become investment property owners because they're purchasing a property with two dwellings on it. That's a way that some people prefer to go. They won't want to live next door and generate that extra income whilst they've still got a place to live. So, what can you borrow and what does that look like for you? And if not right now, what do you need to do to make that difference up? And then obviously there, yeah, have a chat with us. We're always happy to talk through situations and make sure that the options that are in front of you are applicable for you and your situation and that you're looking at the right types of properties, and then just connect you in with really good people who can give you advice on the things that we don't. So yeah, so talking to our team and anyone else. There have been some great questions already. If are there any others? We've kind of tried to keep it pretty broad tonight, because this is about sort of purchasing your first investment property, rather than, looking to build big, long, huge portfolios, because it is something that a lot of people are asking us at the moment. So we really wanted to, yeah, put that word out there to provide some advice and give a little bit of an overview. But like I said, we're always really happy to step in and have a chat with you about what that means for you and for your situation. Greg, have you got anything else to add based on those last few points there?
No, I don't. One other thing, just that I was thinking about before, Claire, where you were talking about the reasons for splitting banks. The
Yeah.
classic example that I had was a client had heaps of equity in their house, had bought a property for one set of their parents, and then was
Mm,
buying another one and selling that one. And they were selling it; they were going to make 400 grand or some stupid number off that property, and they already committed to putting a pool in, doing some renovations at their house, doing some renovations at the new house they brought for the parents. And the bank said, "Oh no, well, you need to pay off all of the debt against your main home." And in the end, we managed to convince the bank that no, they could hold on to all that debt. We needed to do a new application, all these sorts of things. But it was just a classic example where the clients had all these plans for this money they were going to make, and the bank was like, "Well, no, hang on, we hold security over both of those properties." So we can essentially do what we want with the funds, the sale proceeds, unless you can prove to us that you're actually able to hold on to it. So
mm,
yeah, really important to just be aware of what could happen. And
mm,
now we're doing a lot of, hey, I'm going to sell my property. Clients saying to us, we're going to sell our property. What are the implications? So that they're really clear about what
yeah.
those are before they do it. Is there break fees? Is there LVR issues we need to work through? How much debt are we going to have to be repay? All those sorts of things. So it's really important to
Yeah.
even before selling a property, make sure we work through the problems. Sometimes we are selling problems as well.
Yeah.
There is a question here. Hi guys, is investing an option when we are expanding family, reduced capacity to work? Husband still works full time and have equity, but how heavily do banks consider family planning?
This is such a good question. We get it a lot.
We do.
Yeah, so it depends a little bit on the timing. So generally, a bank will look at income as existing or as something that's going to be the case within a 3 month period. So what that means with things like maternity leave is, if you're planning to have another child or you're planning even to have your first child but that hasn't happened yet. It's about having those conversations with us about managing that rather than where the bank's position generally is whatever is existing is what we will take. Yes, they sometimes ask questions about future plans, but it's more around like, what is that going to look like for you? If something was to significantly and suddenly change. The when you do have, say, a one partner who might be on maternity leave, let's say that's a 12-month period, the first 6 months you receive some sort of income, and then when you're within 3 or 4 months of returning to work, generally a bank will probably look at that income as ongoing. Um, but it does depend a little bit on the timing. So it's my opinion on it, and I perhaps have um, yeah, a little bit of a, well, actually, whatever it is whatever it is today because things can change. So I've had friends who have gone back to work within 3 months because they wanted to. I've had people who have never returned to work. You simply can't predict that when you're, 3 or 4 months pregnant. So my view is that whatever's existing, and this is the bank view as well, whatever's existing is what we can rely on. However, future planning for us is also really important. So making sure that whatever your plans are in future is we're considering that as well. But that's kind of how the bank looks at it. Yeah, there's probably a few more specifics based on personal situations that we can
Mm.
explain, but yeah, that's an overview.
Yeah, and I have
Mm,
two clients right at this moment going through this. So one where she's currently on maternity leave, and we have a back to work letter for the next month or so. I think she's going back to work in about 6 weeks,
mm,
and the bank was like, "Yep, all good, no problem." Lines up with settlement, all those sorts of things. I have another client, again, really strong incomes, but she's 6 months into her 12 months of maternity leave, and the bank have said, "Nah, look, we're not going to until she actually is within that 2 or 3 months of back to work. We're not going to lend." So we're getting them into position, making sure it's really clear about when that could be. We're running some numbers based on what her income will be when she's back,
mm.
and they're just going to have to tie ho for a little bit and wait until she's back to work or closer to that 2 to 3 months back to work kind of
Yeah.
situation.
So sometimes it's really interesting though, like just going back to the specifics of the question, like if you've got exceptional equity, very little existing lending and a strong income, like one strong income,
Mm,
there still might be options there. So I
mm,
think just going back to what the specifics of a certain person's situation is, or whatever the specifics of your situation is, we're happy to talk that through and give you some like real numbers, but that gives you a bit of a broad understanding. The other thing that just came to mind that I've got a couple of clients looking at is when we have people who maybe they might be moving towns for a period of time. So, like construction is really common, or sometimes even in public service roles, you might wind up moving for a time. And that's actually often to a regional area and then could make sense to purchase a property and as a investment property for the future, because you're then getting to know a new area and a new town, and the fundamentals of that town and what works. So I've actually had, I think, two or three people who have moved away. So we're based in the Waikato, moved away for a 1 or 2 year period and then have retained rental properties. So one I think in the Hawke's Bay, one in Wellington, and one down in the south in Invercargill. So those are other options too. Like if that does pop up for you, it's not always that you have to sell your current house and move everything. Particularly if it might be a temporary situation. It's just a little bit of an out of the box way to look at getting into a regional centre because they're actually really affordable.
Question here: does the bank or lenders take one's age into consideration? Can someone be too old? Well, that's a great question. So, the answer to that, I suppose, is probably yes. But it more comes down to income. So, uh, as we head towards retirement age, the banks will shorten loan terms. However, investment
Mm.
properties are sometimes a little bit exempt from that because obviously that income is going to carry on. And so, regardless of how old you are, your rental income is going to carry on. There are
Mm.
obviously other types of income that we can prove are ongoing. We can add superannuation in and all those sorts of things as well. But generally, they will shorten loan terms as we get a little bit older, and also generally servicing becomes more difficult because we don't have the same income that we used to. Not every situation, obviously.
Mm.
And also we do have, so we work a little bit with second tier lenders. And in terms of, generally we don't look at them for a super long term. But over a short term, if you're going, hey, I want to buy an investment property, and my plan is that within 2 years, I'm going to move to that property. So a common situation I get is client who maybe lives rurally and is going to move to the beach, but they don't necessarily want to move there right now, and they've got good equity, but they don't have the income. Then we can use their current property and secure the new property for them, and maybe have that as an investment property in the short term to add some more income and to pay the interest on that, and then over time sell that property and move
Mm.
to the new one. So there's definitely some things you can do there as well with second tier lenders. But yeah, it does get a little bit more tricky as we get older. In terms of what age that is, all the banks are a little bit different. Generally,
Mm.
from about 50-ish, the bank starts to like to reduce loan terms as a
Mm.
as a general rule.
It also depends a lot too on what we call an exit plan. So
Mm.
Greg kind of just detailed an exit plan there, which is, hey, selling my property, moving to the beach. Um, excuse me. But also, if you do have, say, a larger property, you buy an investment, and it's a 5-year plan, that investment property is effectively going to pay off your home mortgage. So let's say you've got a couple of $100,000 owing at the moment, you go and buy a $600,000 property, and in 5, 6, 7 years' time, that property's worth a few hundred more. And then the idea is that you kind of go into that end of that situation debt free. That's a situation where a bank might be comfortable with interest only or a longer loan term over a shorter period of time because you've got a really strong exit plan, or you might be going to downsize or kind of activate the equity that you've grown over time to do something else. So it depends a lot on the situation as to kind of age and how that's factored in. But probably one thing I would say is like don't leave it too late. Like as
Mm.
in not that you're never going to be able to do it, but more just the more time that you spend in any kind of investment, whether it's a property or if it's financial investments or KiwiSaver, the longer that you're going to be there and acquire compounding interest or the compounding factor of having that investment. So
Mm.
yeah,
Cool.
definitely worth. Yeah.
Sweet. So I
Oh,
think that's all of our questions, and we've had you for
mm,
40 minutes, 45. So
yes,
thanks so much for coming
50.
along. We really appreciate it. As Claire's mentioned a few times, please feel free to get in touch. So myself, Greg at My Mortgage, Claire at My Mortgage, visit the website, get in touch with one of the team, Amber and Adam as well, are two other advisors who are amazing and do great work with lots of investors. I'm more than happy to have a look at your situation and just run some numbers and go, hey, what does this look like? What can you afford? What could be possible? And often it's, as Claire mentioned as well, what if I can't do it right now? How do I get myself into a position to be able to do it? What do I need the numbers to look like? And we're more than happy to do that as well. So feel free to reach out if you've got any feedback around other things you'd like us to cover in webinars like this. We would love to get those. If there are any other questions as well, please feel free to fire them through now in the chat, or fire them through via email. We'll be happy to look at that. Thanks so much.
Thank you guys so much for coming and hanging out with us tonight. We really appreciate it. And thank you, Amy, for helping with the webinar stuff as well. And thank you, Greg, as always, for being a great partner.
Always a pleasure. Thanks, Claire. See everybody.
See ya.